Well, holy smokes, everyone. It looks like Australia is going to be heading for the first time into negative interest rate territory. And also, the recession that we just had just a few months ago, it looks like we are going to be entering into another recession. Or have we really got out of the recession that we just had last year? In this video, I'm going to be going over the two factors that will be contributing to Australia falling into a recession again. And I'll also be going over the factors that are going to lead us into negative interest rates. And then I'll tell us what we should be doing about it. Okay, everybody, let's not waste any time. Let's get straight into it. So have a look at this, everyone. Australia's heading for negative interest rates as iron ore and the housing market slump. Now, what you have to know is what got us out of the GFC and what got us out of the recession, or the little dip recession, I guess you could say, in 2020, the short and sharp recession, which is a bit of a tongue twister, was booming commodity prices, especially iron ore. Iron ore went completely parabolic, and for every $10 iron ore goes up per ton, that's about another $10 billion for the Australian economy. And what also happened is they cut interest rates very, very low. The average mortgage rate went from around 3 to 3.5%, and you could get fixed interest rates below 2%. For every 1% drop in interest rates, people's borrowing capacity increases anywhere between 10 and 15%. So of course, people don't borrow what they can afford, they borrow what the bank tells them they can borrow. So all of a sudden their purchasing power for homes went up because of lower interest rates. So they could go out there in auctions, they could go and they might get a bit of FOMO, or they might, not really like the guy they're bidding against. And so they had more room to bid up house prices. But now these two cash cows for the Australian economy is coming to an end. Let's have a deeper look. So Australia's economy is a simple machine that runs on two motors. The two engines are commodities and household debt. We might call these miners and banks, or iron ore and house prices. And I completely agree. What we've been talking about on this channel is Australia's economy is not very complex at all. We're doing pretty much what they've been doing for hundreds of years, building houses and digging holes. The machine is fueled by commodity income derived offshore. This is then leveraged up in global markets via bank borrowing. The debt is channeled into rising house prices that drive up consumption. So this is the wealth effect. And this is something I think is a big scam here in Australia. They say, look, we got to pump up house prices so everyone's richer, and then they'll turn their house into a big credit card. Well, what you have to know is this is really a wealth effect for the politicians and those that have, for example, 3 or 4 plus investment properties. For example, I've just built a house. My house has gone up recently. Well, I could refinance and take out that equity, but then that means my mortgage repayments will go up. And that's more of a burden on me. Also, my council rates go up, which is great news for the council. And then if I sell it and if someone buys it, they're now paying more than what I paid for it. So that's more stamp duty for the state government. And also with the wealth effect scam, well, if I sell my house, well, I'm still just getting one house because all the other houses around me have gone up at the same rate. So for the average person, it doesn't really make them better off. It just puts them in more and more debt, and it really only benefits those that have multiple properties. At least that's how it used to work since the pandemic began. The machine has instead leveraged commodity income via bank borrowing from the Reserve Bank of Australia. So again, with the RBA, what they did in 2020 to get us out of that recession and to send house prices to the moon and the stock market was they created a term funding facility where they offered credit to the banks at 0.1%. That's right, 0.1%. And then the banks take that and then they lend you money at 3%. And this has caused, Commonwealth Bank's profit margins to increase by 20%. So again, they say we're all in this together, but this has really benefited the banks and for the rich that own lots of assets. So like a twin-engine aircraft, the Australian economy can soar when both of its engines roar in unison. It can also hold its altitude on only one engine, like what happened in the GFC period when mining boomed and house prices fell, or the reverse during the mining bust of 2015 when house prices went parabolic. But when both engines fail, a crash is imminent. And this is what's happening right now, everyone. So the first jet to flame out is households. So the lockdowns have hammered confidence and spending. business is slowing fast and future investment plans are being shelved. And also companies, imagine if you got, for example, a cafe, a restaurant, a bar. Why would you be investing anymore when you don't know if you could just be shut down the next week? And so we'll have a look at this chart, everyone. This is trading, profitability, and employment. The gray line is trading, black line profitability, and the red line is employment. As you can see, we had a V-shaped recovery out of the 2020 recession, but is now once again, and it's looking like we'll be entering into maybe a double-shaped recovery. Or maybe an A, B, C, 1, 2, 3 shape recovery. Who knows? Maybe every letter of the alphabet. So the second jet to flame out is huge commodity price gains. So China has launched out of its lockdowns with huge commodity demand, but that is now slowing very fast. Iron ore is tumbling and coal is next. Because look at this, everyone. China has slashed steel exports to Australia by 50% to wean itself off the nation's iron ore industry. And what you have to know is China's what got us out of the GFC. We are one of the biggest exporters to China. We make a lot of money by exporting iron ore and coal to China. And if this gets shut down, especially, if the trade wars intensify, that's just going to be a double whammy to the Australian economy. So it says here, it's been the only thing keeping Australia afloat, and now China has moved to gut the iron ore market. Beijing boasts it has slashed steel exports to Australia by more than 50%, and it insists efforts to wean itself off from Australian iron ore and are only just beginning. It quotes an unspecified Chinese steel exporter as saying the trend is set to further accelerate. So as Australia reboots its economy, demand for steel is set to further jump with the rollout of more housing and infrastructure construction. That combined with dwindling imports from China will only widen the supply gap with no other country to fill it. So what that simply means is in order for us to have an economic recovery, we got to build stuff. But if China doesn't give us the steel to build stuff or the things we need, we won't have those resources to get us out of this recession that's staring us right in the face. And we can look at this chart, everybody. We can see here in April, iron ore went from around $80 a ton and has skyrocketed nearly 300% up to around $230 per ton. But now it has collapsed to around $140 per ton. So you may not care really about, the mining industry or whatever, but this is what it leads to, everybody. Listen to this. As the two economic motors sputter, unemployment will begin to rise, wages will weaken, and inflation will disappear. But let's talk a second about inflation and wages, because this is something very important that we must know, and unfortunately not many Australians really pay attention to. All of a sudden, central bankers are saying inflation's great. They normally wanted 2 or 3%, but now they're saying, oh, we want more inflation. It's great. Why are they saying that? They're saying that because governments around the world are going bankrupt, so they need to have high inflation so that way the price of everything goes up. That means their tax revenues go up, and that means the debt, it gets devalued by inflation. Because look at this, everyone. Australia's inflation rate is 3.8%, and they tell us it's good because then your wage will go up and you'll make more money. That's a complete lie. Look at this, everyone. This is Australia's wage index. And as we can see, from around 2004, 2005, a wage growth was around 4%. And now look at this. Wage growth has fallen completely in the gutter, and we're now only getting around 1.5% wage price growth when inflation is more than double that. And that is why the standard of living in Australia is declining rapidly. And that's why you're having families that have gone from one income, a father with 5 kids being able to support a family, to now 2 people, the mother and the father, working with maybe just 1 or 2 children, and they're still struggling to get ahead. It's because of this inflation and wealth effect scam. Wages aren't keeping up with inflation, and they're definitely not keeping up with house price growth. So what can our saviors, our lords, do to save us, the peasants, to get us out of this economic crisis that's facing us? First, the government can spend more, and they will, but unlike 2020 and 2021, as mining profits bust, not boom this time, the tax they take will get smashed, so they'll want to be more conservative. So again, what got us out of the last recession was huge government spending with JobKeeper, JobSeeker, lots of stimulus for the businesses. but they don't have the luxury of that this time, especially with their tax revenue declining, with unemployment rate going up, and also with mining profits going down. That means a second throttle, the RBA will have to carry more of the load. Australia will need to have a lower currency to help offset the collapsing export income, so the RBA will force to increase its money printing and bond purchases at a matter of course. So what that means is the RBA is going to print more money, they're going to buy more bonds to lower the yield on the Australian bonds, to lower the Aussie dollar. That means if you're holding lots of cash in the Aussie dollar, you may want to get some hedges like gold, not financial advice, but just maybe something I would do, because they are going to be trying to lower our currency, and that's something we've already seen. It says the likelihood that the mining income will be shut off throughout 2020, so the RBA will therefore need to rev its other engine, the housing market. Well, here we go again. To boost the Australian economy, the RBA and the government's only got two tools really, mining and housing. So if commodity prices continue to fall, you better believe they're going to pump the housing market again. So either the RBA will have to cut its cash rate negative, or would have to print more money for the banks offered up on a negative yield. So what this means is hopefully we won't have negative interest rates, at least for now, in our bank accounts. But what the RBA could do is, like the term funding facility offering credit to banks at 0.1%, they could offer money to banks at a negative interest rate. And then hopefully the banks will pass it on to customers. But I do expect they will hold some of those rate cuts for themselves to increase their profitability, just like what they did in 2020. So the European Central Bank has been doing both of these things for many years. The European cash rate is 0.5%, and it provides money to the banks to lend as low as 0.1%. The RBA says it will never do these things, but it always says that. And that's, of course, they said 0% interest rates, not likely. QE in Australia, not likely. Well, they went a step further than the US. With QE, they went yield curve control, where they kept buying bonds to keep the yields on the bonds even lower at 0.1 or 0.2%. So I'd bet my last dollar that the RBA will go negative if we enter into a double-dip recession. Because when things do hit the fan, when things are looking very grim, people are going to be calling on the RBA to do something. So everyone, what this means for you and me, this means we're not going to have the mining boom to get us out of this recession. The housing market has been roaring hot, but it is looking like it's going to slow with falling auctions rates, with falling affordability, with more and more people choosing to build a home because of all the government grants. That's adding supply. We've got ultra low migration. So again, just simple supply, demand, economics. That should hopefully cool down the housing market. But it all depends how the government responds here. Do they have one last kick in the can down the road? Will they all of a sudden, give everyone $50,000 to go and buy a house to stimulate the economy, because that's the last tool they got? How deep will the RBA go? If they go negative 0.25%, I don't think they'll have much effect on the housing market. But if they do go negative 1% and the economy isn't in a deep recession, then maybe house prices will continue to grow. But there's so many uncertainties right now, it is very hard to call. So everyone, what we have to do is prepare for any scenario now by having hedges to inflation, hedges against currency debasement, and also we need to become more financially resilient by paying off high interest debt, by preparing for shortages that may come, like having, food storage, your own power supply, water supply. And if the RBA does go negative and the currency falls, gold may be a good hedge against this. And Bitcoin might even boom as well, price in the Aussie dollar. So everyone, that's just some of my thoughts and opinions, what's going on in the Australian economy. You let me know your thoughts down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you updated on the latest that's happening in the stock market, housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you all there.